I'm Olivia Voznenko.
I'm Steve Guilfoyle.
And you're watching Street Smarts
at Modern Wall Street.
Hey guys, welcome to Street Smarts, and I'm sure you noticed we're in a different room. Oh, and we have a special guest, our first special guest of the show.
Yeah, we do have a guy that I have long paid attention to. It's an honor to have our first guest on Street Smarts be Douglas Borthwick, the head of FX at Chapter Lane, a man that called the Trump presidency, called Brexit. He's basically called just about everything I've seen along the way, and he's, as far as I can tell, he's batting 1,000. So welcome, Douglas.
Thanks very much. Thanks for having me.
And the dollar going down. So that's why we definitely, perfect timing to have you on the show. Doug, usually we just do a little market recap, and then we're going to jump into tariffs and trade and macro and all that good stuff. Sound good?
Great. That sounds good to me.
Yeah.
Okay, so let's take a look at these markets. What, we have a triple top now?
Yeah, this morning this morning was very interesting. I mean, you saw the market acting really kind of well. You saw 10-year moving higher. Now the 10-years come in. We had rumors this morning that Gary Cohn was on his way out. The market sold off on that. Then there were rumors that maybe Trump was going to back off on the tariffs. The market rallied a little bit. Now the market's moving sideways. I think we have the S&P at 27, 22. I don't think the market knows what to make of all this. I do know, as an investor myself, that losing Gary Cohn would rattle my cage a bit. This is a guy I want in place.
Which could interrupt this. Generally on the daily, we are seeing this developing upward trend, right?
Oh yeah, I mean, since the flash correction, I guess back in early February, we certainly have seen a series of higher highs and higher lows. So from a technical standpoint, the market does look okay here, but we're skating on thin ice. I mean, volatility is here to stay. I don't think anyone would argue that. There's a lot of reasons to think that as monetary policy normalizes, so will the volatility condition itself. Mm-hmm. And I would really, being we have an FX guy here with us, love to know what you think about the future of the US dollar, given all the events that we're naming and that we did not even name that are out there haunting us.
Yes.
I think that one of the most interesting things that we're working through right now is I think we may have seen actually peak US dollar. Peak US dollar, and that the US dollar for quite some time has been the reserve currency of the world. And generally, the UK was once the world currency. It's sterling. That was rule Britannia. Britannia ruled the waves. Then the US, obviously after World War II came out, its navy becomes the preeminent navy and it's ruling the waves. And I think though you've got folks that are kind of coming out in China now, and it looks like China now, who's a very large trade competitor to a lot of other countries, is now saying, you know what, we're a big trading partner too, so maybe you should pay us in Chinese renminbi rather than in the US dollar. They're now doing futures contracts in oil in China. They're doing futures contracts in gold in China. So the world of this US being the only or the major influence in the world is changing. And what does that mean for the dollar? Well, it means that the dollar now could start to lose influence in the world and could start to weaken going forward. And I think you're seeing this in many, many different ways, in that the US has a strong belief, or at least this administration, that having a strong dollar or a strong dollar policy over the last 20 years has really been great for selling US treasuries, but absolutely horrendous when it comes down to manufacturing goods in the US. Because if you're going to manufacture goods, you don't want to manufacture them in a place where your inputs, like labor, are going to become more expensive by 5 or 10% every year. You'd rather manufacture somewhere where your inputs are going to be cheaper by 10% every year. And so we've had this huge suck of manufacturing jobs out of the United States into Asia. And I think that now the US is looking to get that back. And the way they get that back is by weakening the dollar, by talking about tariffs, and doing these sorts of things that, in essence, are going to bring about US manufacturing jobs. Now, one of the most important things we should be looking at here is China, which is a new currency to many people, isn't part of the reserve management basket for many, many countries. And we believe there's going to be a tremendous shift out of the US dollar and out of US treasuries, you're already seeing this from Japanese investors, into Chinese renminbi. And on the back of that, you're going to see a weaker dollar. You're going to see treasury yields start to rise. You've already seen Japan start to move treasuries out of the United States or assets out of the United States. And that should support the U.S. equity market going forward, because the U.S. equity market will be driven higher by a lower dollar.
I see that. But given that we still have to, the Treasury still has to borrow money, is this a net positive for the economy?
Well, the Treasury is going to have to keep on borrowing dollars, and at the same time, they need to borrow from somewhere like the Fed, and the Fed's kind of stepped away now and said, well, we're not really even doing it. So going forward, the Treasury is going to have to actually have a higher yield on their inputs so that people want to buy it. Now, the US is still that triple A that everyone wants to be a part of. It's still the most liquid asset, and it's still the asset of choice for folks when it comes down to, do you want to hold something and something safe? It's the US Treasuries. But as China builds its Treasury market, I think you're going to see a giant sucking sound out of the US Treasury market into others.
Now, when the Fed manages its balance sheet, we're getting very close to the point where it's going to be a net extractor of liquidity. I think it happens sometime next month, maybe the month after. Isn't that going to put a bit under the dollar?
Well, I think that you would hope so, but let's look at what happened when the Fed expanded the balance sheet. The Fed expanded the balance sheet. U.S. equities went very well bid, but also the dollar went bid as well because the U.S. was seen as doing something to stimulate the U.S. economy. As they start to extract from that balance sheet, the balance sheet starts to wind down. I would expect to see the opposite of what we saw when they were expanding the balance sheet. I'd expect to see equities take a little bit of a dive, a little bit of a hit, at the same time the dollar to weaken considerably too. Because maybe folks will think, the U.S. may be a little bit ahead of the curve here. The Europeans are still sitting there saying, we're not sure if we're going to be reducing the liquidity we have in the market right now. The Japanese are saying, well, let's put it off for a little while longer. Maybe the U.S. is a little ahead of the curve. If they are, and you see a tightening in terms of the balance sheet shrinking, in terms of the U.S. Fed raising rates, that could be seen as a negative for the U.S.
Can I interject, fellas?
Go right ahead.
I just want to clarify so back to the tariffs, if they're terrifying or not. The target is China, yes?
Yes. The target is China. I think the target is, there's multiple targets. The target's really NAFTA, in my opinion.
Yeah, and the reason is really what I was getting to.
The excuse is that China's been dumping steel and aluminum in a game of whack-a-mole, where if you plug the hole here, it opens up here. If you plug the hole here, it opens up there. The aluminum and the steel get here through the favorable conditions of the NAFTA treaty, which was negotiated before this, not before this was a problem, but before this was such a big problem. And it's really gotten to a point where I think President Trump is not wrong at all in trying to solve this problem, but he may be targeting a better negotiation with Canada or with Mexico rather than really China, where President Xi might be trying to maybe rein in pollution or something like that. Maybe he feels they have an overcapacity problem already. So he might have actually told the president, you do what you got to do, you'll look like a hero, and it's going to solve my problem too.
I think that Sarge is correct. I think that tariffs, when it comes down to steel and aluminum, is less about China. Certainly, it throws something into the ring that makes everyone think, oh, maybe we should do something. But certainly, it's a great bargaining chip for Canada and getting Canada at the table in NAFTA. And I think that it's probably going to be used as a tool there. And remember, with this president, when it comes to negotiation, he throws out looking for 100%, and then he's happy if he gets 20%. And I think that that's what we're seeing here. We're seeing him throw a wide one in there that the market then realizes he's really serious about what he wants to do. There's fear in the market. But then people come to their senses, they start talking with each other, and that opens up the negotiations. And I think that that's really what we're seeing here.
Oh, I think it's a brilliant tactic. It's been used by our enemies many times in negotiation. I call that Thor's hammer. Rather than going in with a little surgical tool, this president throws Thor's hammer around. He whacks whoever's standing there. They're blown away by the whole thing. They say, how could you? And then they're willing to settle for less than they previously were. It's really standard deal making.
All right, so success. Short term, long term?
Well, short term, you're going to deal with volatility. I think you could day trade this market. I don't think you want to invest these daily swings we're seeing. I mean, I've never seen such dramatic moves in my P&L on it one day to the next, almost every day for a month straight. It's almost incredible. I think you want to stay the course on whatever your strategy was. If you like growing earnings, a growing economy, synchronized global growth, if you think this is a good environment to be long or short, if that's your prerogative, I would say stay your course and don't get distracted by this unless you really are a day trader.
I think that there's a lot of noise that comes out in the market right now, whether it's Gary Cohn may resign or tariffs or North Korea now coming to the bargaining table. All of this is noise. And generally, when something is seen as negative, it's used as the excuse for why the stock market's come off that day, or instead of trading higher, it's actually moved sideways. And I think that what we're looking at is as you unwind this balance sheet and as the Fed unwinds the balance sheet and starts to raise rates, there's an expectation the stock market will come off a little bit. Now, the excuse won't be, look, they're reducing the balance sheet. The excuse will be, oh, Gary Cohn may resign, or the North Koreans have now stepped away from the negotiation table. So a lot of the time we're seeing excuses, or people are fitting data to markets on a daily basis. But I think that the overall macro theme of reducing the balance sheet is what's going to see the stock market trade sideways or lower.
So we're denouncing that the tariffs are not a blow to North Korea, not to get China against North Korea.
No, I don't see the tariffs having anything to do with North Korea or with China. I think that the tariffs certainly are to China. They're seen as a salvo in that it says certainly we don't like dumping, but generally the area you deal with that is maybe at the WTO and not necessarily by doing an ad hoc, let's just throw tariffs on all of our trading partners.
It is funny you bring up North Korea, though, because all of a sudden Kim Jong-un's a nice guy.
That's what I'm saying.
So,
what are the odds?
That kind of, to me, backs up what I was saying a few minutes ago, that President Xi is probably in on this, and he probably told Kim Jong-un, hey, go play ball with these guys for a while, because we're gonna let the water settle. And we're going to play ball. We're going to make believe everybody's going to hold hands in the long run here for a little while this settles down in the U.S.
There's a massive group text going around. I swear, these guys just text each other like, all right, you say that, look good, whatever. Tell your wife I said hi.
North Korea is, I guess, an interesting one in that it's being hailed as being, great that he's going to come to the table, and North and South Korea are now going to talk again. What's interesting is that we've been in this situation now. It's like every 4 years where North Korea does a lot of saber rattling. They then sit down with the South Koreans, with the United States. They then gain some concessions and some aid.
Which is exactly what Donald Trump does.
And over this time, as the negotiations are going on, they build up their nuclear regime. And I think that, will Trump fall for this? Maybe, maybe not. But right now, I think that we were in this situation where everyone was very anxious about nukes, and for good reason. But I think now this is a little bit of a time where we can pull back and we can reflect. But I don't think that in the end that these discussions are going to end up with anything fruitful.
And what about the backlash from other countries, like the EU? Now they're up on everyone's grill that they're going to put a tariff on Levi's, deny the Europeans of Levi's jeans. What's that about?
I think they're targeting certain senators, certain congressmen here in the U.S. by targeting businesses from those states. I don't think that's particularly damaging. I actually wrote a piece on Harley Davidson this morning. I wasn't particularly favorable on the stock, and that was aside from all the tariff talk. I'm sure it hurts Levi's, it hurts Harley Davidson, it hurts the sellers of Kentucky bourbon, but I don't think that's a dramatic blow, and I think it was almost laughable of Juncker to bring it up.
I think that it was an off-the-cuff comment that was picked up by the media, because certainly the EU doesn't work in a way where suddenly one person comes up with an idea and throws it into the market. Instead, what happens normally is there's a discussion that goes on for 6 or 7 months and nothing gets accomplished, and then they come out with something. So I think this is an off-the-cuff comment that's been picked up as being EU retaliates, whereas in reality it was probably just a comment of some,
And yeah, the euro's been pretty range-bound.
And then what comes after Thursday, Olivia?
NFP, non-farm pay goals. Just saying.
Will that matter that much, though? What do you think?
What'd you say?
Will non-farm payrolls matter as much as some of the other meat and potatoes within the employment situation?
Listen, it's honestly, it's really not about the number. It's about how the market reacts to that number, and I think it could be a mover.
I think that non-farm payrolls we'll see a number probably pretty close to 200,000. I think that being we got the hot 2.9% wage growth last time, even though it was on less hours, so it actually worked out to less money for the average American worker, but it was taken as inflationary. I think that's the number that the market will focus on. And we're looking for 2.8% year over year for that number. And don't forget, these 2 months, the number has been bloated somewhat by these $1,000 and $2,000 bonuses that American workers got across a myriad of U.S. corporations. So it's a little bit of a false flag. So I think you'll probably see expectations for inflation come in a little bit on this employment report. Not that I can guarantee anything. I've been surprised by these numbers before.
That's what I'm saying.
But I think you might even see a downtick for participation, which has been running around, I guess, 62.7. I think and that's down from late 2017. I think you'll probably see that number coming around 62.5/6. So I think this might be a month where the employment situation takes a baby step backwards.
I agree 100%. I think that the only surprise, or the only thing the market really cares about is if it came in sub 100. So that would be a big surprise to the market, and then folks would start questioning whether 3 more rises this year, or 4 more rises this year, or maybe just two rises this year would come from the Fed. But I think that the likelihood of this is low, but it's still a possibility. I think anything though, like 180 and above, it's just market plays along as usual.
What do you think? 3 or 4 rate hikes this year?
I think we'll see 3 rate hikes this year.
That's what I think also. I think 4 is a little bit of a pipe dream. I think we would love to see the long end take off a little bit and them not have to push too hard on the short end. That would give us the spread that all the banks need. But I really don't see 4 rate hikes as being. We're seeing some of the macro come in a little crooked the last couple of weeks. Nothing's.
Crooked macro.
Well, nothing. It's waning a little bit. The hot expansion of our macro situation here in the U.S. outside of the manufacturing surveys have come in a little bit below expectations, you might say.
All right,
Factory
cool.
orders, durable goods, that type of thing.
Yeah. Well, I guess because we have Doug on today, we're not going to do a market rush. But let's do, fellas, let's do a quick trade. What's the trade?
Okay, I actually have been long the semiconductors for a long time, and I'm staying there. It's been the hot sector for 10 years. It's still the hot sector. Artificial intelligence, big data, you name it. Autonomous vehicles, almost all your little cell phone that they're so worried they're not selling a lot of. Well, how many chips do you think it needs, an Alexa device needs? A lot more than a cell phone. And that's only going to get bigger, larger and larger as artificial intelligence and that like take off. So I see as tech expands, the need here for DRAM, for NAND, that's only going to expand as well. I picked up Micron last week during the sell-off. I wrote a piece about it. So far that trade is working. I like Intel. I wrote a recent piece on that also. I've always liked Intel. I've been long it all along. I've actually increased my position there. I've stayed long NVIDIA. I like the guys that make the silicone, make the pieces, make the parts and pieces for the chips. Lam Research, Applied Materials, KLA Tencor. Those are the stocks I like right now the best.
You just like it all.
I like that group.
How about you, Doug?
I think that the weak dollar story is going to continue. I like weak dollar against the countries that have a trade surplus with the United States. Canada's had a nice jump up on the back of this tariff news, but I think you're going to see that collapse going into next week as the tariff starts to get pulled back. I think that dollar yen is very ripe for a move down below 105 and then through 100 on the back of just a few weeks ago, the BOJ warned folks through the Nikkei newspaper that they would start to withdraw the leverage that's allowed in retail FX trading. Retail FX trading is the largest trading part for dollar yen. If they have to reduce the exposure that they have, there's going to be a tremendous selling of dollar yen. And I think we could go down to that 100 level. I also think behind the scenes at G20, Secretary Mnuchin is talking to folks saying, why does Japan have a free rein to weaken their currency to stimulate their domestic demand? They're the only country in the world to have that. I think that's going to get pulled away from Japan, and that'll see yen strength. And then dollar Canada, we just talked about dollar Canada, the euro obviously should move higher. Merkel's back in government, that's looking strong. Italy elections are behind us, and I think we're going to see this nice move to the top side.
Wow.
Well,
that's very interesting. And that's good for my equities.
Well,
it's great for equities.
Well, that's why we had him on the show, just for that reason.
That's right. Come back anytime.
anytime. Yeah, Doug, this was awesome. Thank you so much for being our first special guest.
My pal.
I know. Thanks, Stephen, for that. All right. Listen, we text too. Anyway, guys, thanks for tuning in to Modern Wall Street's Street Smart. Hope you learned something.
Thank you.
Doug?
Thanks very much.
It's been real.
Thank you, Doug. And thank you for watching.
Bye.